All right, good morning, everybody. Thank you for coming. I wanted to just talk really briefly about exam 3. And I know there's some cries of desperation. And remember, I sent out a message and I was like, look, guys, I know that it was to be expected, honestly, because this is a trend I normally see with the test averages in this class, where exams 1 and 2, there's some people who are messing up on that, but some people do smooth sailing for those 2 exams, and then are sort of hit with like how much stuff there really is to contend with when it comes to like the rest of the exams in the class. That's not to say you can't do better. Of course you can, but in order for your performance to change, something in the way you prepare, the way you work through the class, whatever you're doing needs to change. Whether that's more time or more effective time, whether that's, not memorizing journal entries, but really understanding the narrative behind the transactions that we're recording so that your mind is better able to retain and put those ideas together in a way that makes it less difficult. Especially with the inventory system, there are just far too many types of journal entries, depending on whether we're working through a perpetual or periodic system. The calculations change based on cost flow measures. We're going to talk about a Lifo reserve adjustment today. We're going to look at like Lifo liquidation profits. We're going to look at lower of cost or net realizable value, or lower cost of or market, which is another adjustment that needs to be made to the inventory system. So there's a lot of stuff going on. And it really, it becomes just too much for you to just try to remember all these tiny little journal entries and ignore the narrative. I mean, it's hard enough just building that narrative and then incorporating the journal entries, but it gets so much harder if you don't have anything to guide your intuition. It's just going to seem chaotic. Like, why do I credit this account, not this account? Why am I debiting this account here and crediting it in the next place? So you really need to kind of get a more holistic understanding of it. In terms of some sort of a curve or bonus, there will be one. I haven't decided 100% what I want to do. It'll be some effort-based thing, so that, you go through and figure out what went wrong, or just revisit accounts receivable in some way, in order to get this bonus, more so than just like filling out a survey or doing a practice set or just trying to do a practice set, because I'm probably going to offer at least 10 points on this last test. So keep your head up, keep working hard, and let's dive into the inventory because we got a lot to discuss today. When we left last time, I just started talking about cost flow assumptions and how the cost flow assumptions affect my inventory system. So the choice of the cost flow assumption, first thing, of course, is that, there's no change to how I record purchases. Purchases are still based on whether it's FOB shipping versus FOB destination. That determines when you recognize a purchase. It doesn't change the inventory count. So at any time, of course, the reality of the number of items I have available for sale, or the number of items that are left in the warehouse in my ending inventory count, will not be changed by my cost flow assumption. What gets changed is the price of the ending inventory under the periodic method. So remember that under the periodic method, we're forced into this equation because we do not keep track of cost of goods sold when we make the sale. We infer cost of goods sold by using this equation. We know that, we started with a certain amount, we purchased more, that gives me everything that I could have sold for the period, right? I mean, we're including all net purchases. So if we're talking about like the first quarter of a year, this is stuff even that was purchased as long as title is exchanged on March 30th. That gives me goods available for sale for the entire period. Then I go in and I make a count in my warehouse. I count the number of items. Now the question becomes, well, all right, I have 100 items. 100, that's the number of inventory units I counted. What cost do I assign to those? Should it be the cost of the things that were in my beginning inventory? Should it be the cost of the things that I purchased? And if it's the purchases, should it be the stuff I purchased like back in January? Should it be the stuff I purchased in March? Or should it be maybe an average of those? And that's where the cost flow assumption comes in and gives me a dollar per unit value to assign to those units I've counted. Now, the same thing happens under a perpetual system, except that we are having to record it at the moment of sale. And so we don't consider all the goods available for sale under a perpetual system. We only consider the goods that we've bought up to the date of the sale. So if we make our sale, say our first sale in January 15th, and we're only going to consider the stuff we began with at the beginning of the quarter in January 1st, and then any purchases I made up to January 15th, because the sale happened on January 15th. If we're going to record cost of goods sold at that date, we apply a cost flow assumption based only on the goods I purchased from, or the beginning inventory of January 1st, and any of those purchases between the beginning and that sale. And like I mentioned before, cost flow methods don't relate to the physical flow of goods. Most physical flow of goods is FIFO, because people are going to, or the stores are going to stock things such that we buy, they're clearing out their inventory. They most likely even have their most recent purchases back in the storeroom, not out on the shelves yet. So we're going to typically buy stuff that was ordered and brought to the store a good time ago, at least days ago, weeks ago, or maybe in the past week or two, and not the stuff that they just bought today. So most of the goods that we buy are on a FIFO physical flow, but we don't have to follow that. We can decide to use LIFO or FIFO based on other issues or incentives that we have in our reporting system. And that'll be important when we talk about the assumptions or the advantages and disadvantages of the different types of methods. I spoke pretty briefly about these. I was pressed. I was holding you a little longer, a few minutes over time. Remember that specific identification can be used. This is where every unit I sell, I can trace it with a serial number, a product number, and I know exactly how much that item cost me to buy, to acquire, or to build if I'm a manufacturer. So think about low sales volume, high profit transactions where we're very, very discreet about what we're selling. So we're talking about maybe jewelry, right? Very unique items. Guns all have serial numbers. Cars all have VINs. So we know exactly how much those things cost. And when one of them is sold, we can determine the appropriate cost of goods sold. There's really not an assumption under the specific identification method. We know we can trace, all right, we made sales revenue of, cars these days, like $75,000 selling that car. It cost us, I don't know what a car costs to make anymore. Let's just say $25,000 to build. All right, 75, 25, we made $50,000 of gross profit on that one sell. Average cost, right? So we're taking all the items that we had, all of the items we have at the time, and then just dividing the dollar value of all of that by the units we have available. And depending on whether we're using periodic or perpetual, that will change. Remember that under the periodic, I'm talking about all the goods for the entire period. So like all the beginning inventory and all the purchases I made in January, February, and March for quarter 1, divided by the total number of units I had for quarter 1. That's periodic average cost. But if we use perpetual average cost, then we think about the average of, I gave the example of I made a sell on January 15th. I think about the average cost of the beginning inventory and only the purchases up to January 15th. So that one is more of a moving weighted average rather than a weighted average in order to figure out the perpetual. First in, first out, right? It is the assumes the goods are used in the order purchased. Older purchases are sold first. So the oldest stuff that I purchased is going to be sold first, which means that with this, you're always starting with beginning inventory and working forward chronologically. So I start with the beginning inventory. I assume I sold all my beginning inventory first. Then if I have to sell more units or I've sold more units, I move into the very next purchase in terms of the calendar, right? Chronologically. Last in, first out is where I start with my most recent purchase. And that's what I decide that I sold first. And so that's when I start at wherever the end of the period is and start going backwards. So I start at the end of the period, I work backwards, and I sell off all my most recent purchases, and then I go back in time to the next most recent. Beginning inventory is the very last place I draw from in the last in, first out. And what follows after this is, I'm not going to put this. I usually have a very different sort of inventory question on the exam than I'm going to do this time. And it gets a little intense. And I feel like I can be that intense in class because I really go around and work with them and we draw these tables and we really start getting into the tables. But I'm sort of going a little bit more basic for online. Like, for example, in this question, there are discounts and returns that you have to account for within this system. And it's a little it just becomes the arithmetic becomes a little tedious and overwhelming, and that's not really what I want to do. But I do want to take this example and just show you, walking through the different systems, which goods would be marked sold, which ones would I actually include in my cost of goods sold for the various cost flow methods. I will put up a video of me working through this entire thing, the old way, or considering discounts and returns and additional freight and all of that stuff. But it just seemed a little bit too much for the time we have and the modality that I'm dealing with right now. So for Fifo Periodic, like I mentioned, we want to sell the beginning inventory first. And another big thing that we have to consider is not on the periodic methods, people are usually tend to be okay, but they can get a little confused. So remember, when we're doing a periodic method, we're recording cost of goods sold only at the end of the period. It's an adjusting entry. And so if we're, at the end of the period, we're at January 31st, and we want to record cost of goods sold, we want to record it knowing all of this purchase information during the year. Well, of course, the first thing we need to know is, well, how many units are we accounting for? Because remember, under the periodic method, we're doing an inventory count of the number of units I have, and I'm trying to figure out, well, what is the cost I should give those units? So how much would I count, assuming I don't have any theft or missing units? All right, well, I sold 500 here, and I sold 1,000 there. And those are the only two sales that I have during this month that I'm accounting for. So I sold 1,500 units total. And so now I just need to go through and ascribe what cost am I going to assign to those 1,500 units. With the periodic, I start at the very beginning because I'm considering the whole month and I'm using FIFO. Well, 200 of those units are at $7. And I'm just going to use the whole prices. These prices would change based on the fact that there's discounts. The number of units would change because of the numbers of returns that I have. But I'm not going to calculate exact cost of goods sold in inventory. I just want to show you where to get them from so that you know which ones to grab. 200 units, and then I go to the next because I only have 200 of the 1,500. I'm going to grab those 1,100. If you were considering the returns, you would have to know, oh, there's not really 1,100 there. I bought 1,100, I returned 15. That would be 1,085, but I'm going to ignore the returns for now and just use all of that. That's on 1/8. And then finally, we got 1,300. So I only need 200 more. So I only need 200 at 9. I don't need all 350. And that's going to leave 200 remaining in that layer. So basically, if I sold all these, I'm sorry, that's going to leave 150 in that layer. If I sold all these and only had, then I would only have in my ending inventory those and those units. So that would be how I would get cost of goods sold. And the ending inventory would then consist of 125. Did I write wrong here? Oh, I wrote the purchase date, not that, sorry. That's not 110. Those are 125, 200 at 9. And then at 125, I have now remaining 150 at 9. And I also have on 129, 400. And for some reason, I don't give the dollar value there, but it was probably $10 or something. These are my ending inventory. But I just wanted to show you kind of like what we're doing. All we're doing is, all right, let me parse this apart based on if I'm talking FIFO, if I'm talking LIFO. So for the perpetual method, actually, and I'm going to prove it to you, under FIFO, even though the journal entries change, the amount of cost of goods sold and the amount of ending inventory stays the same, whether we're doing periodic or perpetual. And we'll see, because it'll end up that I'm going to record the same things as cost of goods sold and ending inventory. So, oh, and remember again, on 131, I sold that many total. On 131 is the date that I want to make the cost of goods sold entry. So basically, I would total this up. That would be my COGS in that long journal entry that is periodic. For the perpetual method, I stop at every purchase and I record a sell. So for any perpetual method, make sure that you stop at every sale, and only consider inventory to date. So only to that date of sale. Looking through my problem, my first sale happens on January 10th. I sold 1,000 units. So under a perpetual system, my first cost of goods sold entry would be on 110. I have to match that cost of goods sold entry with the sales entry. So what did I sell on 110 given the FIFO method? Well, I must have sold first the 200 units from this. So 200 units at 7. And then I also sold, I need 1,800 units at 8. So those were the ones I sold, right? That cost of goods sold entry, if we ignore the discounts or returns, is really easy to make. It would just be 200 times 7 plus 800 times 8. And then we debit cost of goods sold, credit inventory. All right, so then we're under the perpetual method. Our next cost of goods sold entry is going to happen at the next sale. And that's next sale is on January 30th. On January 30th, I sold 500 units. And again, I want to think it through perpetually. So I go all the way back to the top and grab what is the oldest stuff that didn't already get sold. Well, I sold 800 units at 8. That left 300 units at 8 there. So I sell those 300 units at 8. And this is my COGS entry with the sales entry. I sell those 300 units at 8. And then I go to the next purchase and I sell 200 units at 9. And then, I'm sorry, that wasn't on the screen. So that's what the value of my entry would be: debit cost of goods sold, credit inventory. Now let's compare, right? Let's see. Like I said, this should be the same amount as I recorded under the perpetual method. And it is. So all 200 units went into cost of goods sold here. All 200 units went into cost of goods sold in the first cost of goods sold entry. All 1,100 at 8 went into cost of goods sold. Well, 800 went into the first one, and the remaining 300 went into the second one. All 200 units, not all of them, but 200 units at 9 went into cost of goods sold in the periodic. And these 200 units went into the cost of goods sold entry on 130. So, and just to reinforce, in case you haven't like distinguished, remember that, like I said, this would just be a debit to cost of goods sold, a credit to inventory at 110. This would be the same at 130. And up here, though, I would have it all at 131. And I would have that long entry where I have my ending inventory debited. I have cost of goods sold debited. I have purchase discounts debited. I have purchase returns debited. I have inventory credited for the beginning balance. I have purchases and I have freight. So it's a very different creature to record cost of goods sold, whether I'm using perpetual or periodic. Obviously far simpler in terms of the journal entry under periodic. And we don't have all these other accounts. We don't have purchase discounts, returns, purchases, and freight, because the perpetual system just debits and credits inventory for all those items. So there's no need to invoke those accounts. They only occur under the periodic system. Okay. So one thing to know, under FIFO, perpetual and periodic will always match. Looking at Lifo periodic for the same, what goods are we going to draw out of our list to account for cost of goods sold under Lifo Periodic. Again, we sold 1,500, the 1,000 units that were on 110, and the 500 units on January 30th. Still, we're just going to make our COGS entry on 131 because we're using periodic. We don't update COGS at the point of sale. And because we're considering the entire month, because we're under periodic method, the entire period that we're looking at, I'm going to start at the end of the month, right? I'm going to have these 400 units that I don't have an identified dollar value for. So I'll just put dollar value question mark, but those are the 400 I'm selling. And then I would sell the next units, the next oldest units. Well, then I have a purchase at 350, at 9. So that's 750. All right, I need 1,500 altogether. So I'm going to take 750 from that layer, 750 from this layer here. Be careful, don't grab, I almost grabbed the sale, not the purchase. So this is the 1,500 units that I've counted as a sale. This is how I'm assigning cost of goods sold to them. So I have 400 at 129, 125, and then 18. That's the breakdown of the 1,500 units I sold and assigning a cost to what I sold. And then the ending inventory is easy to list out because then it's just whatever's remaining. All of the 129's gone, all of the 125's gone. The January 8th, well, then it only has 350 left. And the beginning units are still there too. So it left all that stuff in the beginning because it assumes we sold everything recent. Now, perpetual in LIFO will not necessarily equal periodic. It doesn't have that same relationship that the FIFO does. So when I'm doing the periodic, or sorry, the perpetual, again, I'm going to have cost of goods sold entry on every date that I've sold something. So I'm going to have COGS entries on 110 and on 130. So for 110, I stop here and I only consider the stuff I've bought to date. So I sold 1,000 units. I only have 200 and 1,100 at these price points. I consider only my most recent things, which come from this layer here. So for 110, it would be from 1/8, the 1,000 units at $8. And so it would be, ignoring the discounts and the returns, it would be $8,000 of cost of goods sold. And then on 130, I sold 500 units. So it would come from the 129, 400 units. And then the rest, the remaining 100 would come at the $9. So that's what I would ascribe to cost of goods sold at 110. And then both of these is what I would ascribe to cost of goods sold on 130. So remember, just with the perpetual, don't make the mistake. I see a lot of students like, oh, they're like, okay, perpetual, I need to make a journal entry at January 10th. Well, I sell the most recent units. And then they skip all the way down here and they're like, okay, well, these need to go because they're the most recent. But you know, you're in real time. You're not at the end of the month looking back on everything. You're at January 10th, you just made a sale. You don't know any of this future information. So you have to just go with the most recent purchase from January 10th. And then the final guys, which I don't see my little area for them. Maybe it's under here. Yeah, it is. I think I did it out of order. I put the weighted average. I did FIFO first and have the others. For weighted average, remember that what we're looking at is getting first a weighted average. And what weighted average would mean is if I'm just looking at these three price points, I don't say 7 plus 8 plus 9 equals X. The average of those three prices is $8, right? That's a simple average. The weighted average says, well, I have 1,100 units at 8, so $8 is going to count a lot more in my average than 7 or 9 because there's like, a third or fewer of those units at those price points as there are at the $8 price point. When you're doing the periodic method, the absolute, it's actually one of the easiest ways to calculate cost of goods sold, because all you do is take your GAFs, the goods you have available for sale, their dollar value, and divide it by the units available for sale. So for this, if I'm doing periodic, I'm thinking about the whole month. Of course, I ignore sales at this moment. I'm just looking at, well, what is the goods I have available, which is my beginning inventory, my purchases, and then counting the number of units. So again, ignoring this discount and returns, I have 200 at 7. So I'm just going to write out like a long arithmetic here. 200 at 7, which is 1,400. I have 1,100 at 8, which is 8,800. I have 350 at 9. Let me do a little mental math here. 2,700 plus, I think it comes out to 3,150. And then we have the unknown. So 400 times whatever that dollar value is. That would be divided by all of the units, 200 plus 1,100 plus 350 plus 400. And that gives me the weighted average price per unit. And I'm considering all of them at the same time. Then I take whatever that is, multiply it by the units sold, which in this case is 1,500. And that gives me my total cost of goods sold. Still going to report only at 131. Adjusted for an adjusting entry with cost of goods sold. It's still going to have all those accounts, purchase discounts, purchase returns, etc. But it's going to happen at the end of the month. Therefore, we consider all the items at the end of the month. If we're talking about perpetual method, it gets a little bit more tedious to do the moving average because, and you'll see why in a moment, we stop at the first cell and we only consider that we have these 200 and these 1,100. So it's going to be my GAFs at that point divided by my units available at that same point in time. And so that's going to equal, in this case, 1,400 plus 8,800 divided by 200 plus 1,100. And for that one, I'm actually going to use a calculator. It might come out even, but it's not necessarily going to. Nope, that's correct. $7.85 if I round. That's per unit. And then I just multiply it by the amount I sold there. That would be my cost of goods sold at 110. Now, the only thing that becomes a little bit tricky or the thing you have to remember is I had 1,300 units at 110. I only sold 1,000. So I still have 300 units remaining after 110 sale. And those 300 units have now been assigned a price of $785. So that is going to be my first goods available for sale in my next moving average. Then I would add to that the 350 at $9, which is 3,150. So we got, sorry, first I'll start off with 785 times 300 plus 350 times 9 plus the 400 units times the mystery value. And I divide that by 300 plus 350 plus 400. That becomes the next moving average that I would apply when I think, oh, I sold 500 units at January 30th. And then I would multiply that by 300 to get the cost of goods sold at January 30th. Okay. So the perpetual moving average is a little bit more tedious because you do have to take multiple averages, and you have to remember that even after you calculate an average at a sale, that average is still coming forward. I don't want to say, for example, I sold 1,000 units, and so that means I have 300 left. Well, I'm going to assume that it's 300 at 8, because if you're going to make that assumption, you're not using a moving average anymore. You're using a FIFO assumption that these 300 are the last ones you have left. When the average cost says, I don't consider individual dollar amounts anymore at unit values, I get an average, and that becomes the amount I ascribe to every unit I sell. And so it then rolls forward as 785 at 300, because that was the average of these two guys here. And then I add in the effects of the new purchases and average them all out. Oh, sorry. Yeah, that was my mistake. Someone pointed out that I screwed it up. It shouldn't be 300. I don't know where I got 300 from. Yeah, no, that should be 500. Any other questions?